This podcast channel is about you, successful international entrepreneurs, successful expats, successful investors. Sponsored by HTJ Tax.
Again, thank you for joining us this afternoon. My name is Darren Joseph. I run a semi-autonomous tax team within a larger practice called Moores Rowland. We're primarily focused on Asia. We have 30 offices in 12 countries in Asia. So from as far north as Tokyo and Beijing all the way down to Australia. I actually am based in Singapore. I've been based in Singapore for the past 7 years. I'm not in Singapore right now. I'm in Portugal. I kind of move around a bit, like many of you. I move around for work. Now, because I am licensed by the U.S. Department of Treasury, you know how this goes, right? I am legally required to say that everything that we say this evening should be taken as an education piece. We're not here to give advice. I know that there's always a minority of people who would think, you know what, I'm going to come, I'm going to listen to this webinar. At the end of it, I'm going to be a tax expert and I'm going to make decisions based on what they tell me. No, that's certainly not our intention. We're having a general conversation about general principles. If you want what we would call actionable intelligence in terms of getting advice that you will take action upon, then you need to engage someone who knows your situation inside out. So again, this is not advice, this is an education piece. And again, nothing we say here should be construed as encouraging you to pay less than your fair share of tax in any jurisdiction in which you're exposed. And I have it in writing as well, just in case. Okay, so that's how I stay out of jail. Thank you very much for your patience. Now let's jump in. So when we talk about the long arm of the law in terms of the Internal Revenue Service, these are two guys that unfortunately have seen the inside of a prison cell because they have found themselves on the wrong side of the IRS. We can come back to them later on if they come up in conversation as we go through your Q&A. Now, essentially, these are the key points I want to raise. I'm going to spend time really talking about what your key responsibilities are as U.S. exposed persons. And I'm going to touch on the stimulus payments because obviously people have a few questions on that. So I'm going to run through a few slides on that. And then we're going to just give a helicopter view of what could be coming up in terms of the Biden tax plan and the President Biden. So citizenship-based taxation, I don't think I need to say that the US is one of those countries that does practice citizenship-based taxation. Like many countries, the US does tax you on your worldwide income. That is not unusual. But what's unusual about the US is that regardless of where you go, even though you spend time outside of the US, you will be subject to the long arm of the IRS. There's no avoiding that. Whereas other countries, by spending a sufficient amount of time outside, you can avoid being subject to taxation, not with the US. Now, then people ask the question, well, I'm outside of the US, how is the IRS going to know what I'm doing, how much I'm earning? That's where FATCA comes in. The Foreign Account Tax Compliance Act, what that has basically done is empower the US government to go signing a bunch of bilateral agreements all over the world. And these, as a nation like Israel, signs the agreement with the US. What they do is then they enact domestic legislation, which requires financial institutions within Israel to go through their books, and anyone that they deem to be US exposed, even if the person denies it, because I have multiple passports, so do many of you. Even though you may have opened the account and you operate the account with a different passport, if the financial institution suspects that you are US exposed, they are legally required to report you to the Internal Revenue Service. So that's how FATCA works. It's basically a framework for information exchange. When I say US persons, I'm talking not just about US citizens, that's kind of obvious, but also green card holders as well, lawful permanent residents of the US, as well as those impacted by substantial presence, which is quite a number of people. Sorry, I'm getting some feedback, so I'm going to mute some of you. Right. Also, but also people who spend a lot of time in the US, which has been the case in 2020 because of travel restrictions. People could not return to whatever country they would have wanted to return to. So, through no fault of their own, they would have spent more time in the US than they planned to. But spending a lot of time in the US also triggers tax residence. Then we speak about, then we encounter, at least in our practice, a lot of what we call accidental Americans. What do I mean by that? I mean, people who may be born to at least one US parent. If you're born on US soil, that's pretty obvious. You are American by birth, right? But if it is if you're born in Israel, if you're born anywhere else in the world, but at least one of your parents is American and they're deemed to have been domiciled in the US, just one parent, don't even need both, just one parent. There's a strong possibility that you may be a US person and subject to taxes as well, even though you've never registered that birth with the embassy, you don't have a social, you don't have a passport, you may still be US exposed. And then there are those who, even though they are married to someone who's not a US person, that non-American spouse can elect under Section 6013G, can elect to be treated as a US person for tax purposes. And that could be a strategic move depending on your situation. In the Q&A, if there's any interest, we can get into that in more detail. So, responsibilities of US persons. So, I think it goes without saying, well, yeah, file and pay taxes. That's obvious. But what is somehow perhaps not as well understood is information reporting. There's a lot of the tax filing that has nothing to do with the calculation of a tax liability. It's strictly about reporting information because Uncle Sam wants to know what US exposed persons all over the world are up to. And I know it may sound counterintuitive when I say this, but with the US tax code, you may be subject to a greater penalty for not reporting a transaction or not reporting a foreign asset than you would if you simply didn't pay your taxes. So that tells us that what the Internal Revenue Service is really after is information. Information is super important. So those information returns, please pay attention to them. Now, this to me is the cornerstone. It's a little acronym that I made up called BEST, BEST. So do your best. And I tell this to those who may be living outside of the US for the first time, right? So BEST, bank accounts. As I mentioned before, this is not new. This is under the Bank Secrecy Act. This dates as far back as 1970, 71. But post Patriot Act, it has a lot more bite to it. What do I mean by that is that you are required to report financial accounts held outside of the US. And when I say financial, not just bank, but brokerage accounts, unit trusts, mutual funds, certain pensions, certain insurance policies, depending on whether there's cash in the policy or not. It must be reported to the Internal Revenue Service on your tax return. So please keep in mind, bank accounts must be reported. That's B. E, estimated taxes. Now, when you are in the US, you get paid on a W-2, and there is withholding every couple of weeks, every month, depending on the frequency of your pay. So it makes it easier. There's nothing for you to do, right? Simple. Obviously, when you're working outside of the US, it's not going to be that simple because there's no automatic withholding as there is when you're on US soil. So it is incumbent upon you as a US exposed person to work with your tax professional to calculate what your estimated tax liabilities would be and make sure and make those payments. The reason why is that, the Internal Revenue Service does not like to wait until the following year to receive payments. So like in 2021, you should have already made your estimated payments for 2020 already based on your expectations of what you're going to earn. So get your estimated payments right. Otherwise, you may face underpayment penalties, which depending on the amount of taxes could be pretty steep. State tax issues. You have 50 different states, 50 different rules, but most of those states are domicile states. What does that mean? It means that under certain circumstances, even though you are living in Israel, you have not been back in California, or you have not been back in Virginia for years, you have not even been on US soil. You may think, I don't need to think about state. Yeah, you do. Aside from the obvious, if you have state source income like a rental property, depending on your situation, you actually may still be domiciled in that state. Depending, I'm not saying that one size fits all, but certain people are still domiciled in this state. And you may think, well, I'm not there anyway, who cares? We've had too many instances of clients at some point in time returning to the US, and they get hit with a really high state tax bill because the state keeps records. They are waiting for you. The franchise tax board in the state does communicate with the Internal Revenue Service, so they know how much you earn, and they sometimes can make an estimate as to what the expected liability would be. Bottom line, pay attention to your state, get advice, make sure that you are not still stuck to that state. Last but not least would be the transfer taxes. And these are perhaps less well understood, right? These are your gift and estate taxes. So you're outside of the US, you get into a relationship, you marry someone who may not be a US person, they're not US exposed, and you receive a gift from them, you write a check, you gift them something, part of the relationship. Otherwise, we see situations where people see great business opportunities, they're entrepreneurial, and they give their friend or whatever, they invest in a business, or whatever the case may be. There's a transfer of assets back and forth. Under certain circumstances, that needs to be reported as well. Again, this is not about calculating taxes, but remember what I said earlier, that the service places a greater emphasis on information. They want to know what's going on. So the penalty could be, depending on the situation, up to 30% of that unreported gift. So again, when you're working with your tax teams, make sure you let them know whether you've gifted something to someone or you've received a gift from someone. So that's important. Now I'm going to touch on stimulus payments a bit. And of course, it's on, something that people are aware of. It's not a lot of money, but, every penny counts, right? So there've been two rounds, which I'm sure you're well aware of. And I have everything on the screen there. This is the amounts. Once you have a valid social and you are a citizen or green card holder, you should have received it. You should have received it. Many people who were e-filing and maybe they had their bank accounts and their tax returns to make payments or whatever, it would have gone automatically to their account. Otherwise, you would have got a check in your mail at your last address. For those who did not receive it for whatever reason, it's not too late. There is a new line on the new 1040s, the main tax form for 2020, which it's not finalized as yet. The IRS is still working on it. Tax filing season has been delayed because of things like this, because of these last minute changes that happened late in December. So the bottom line, it means that if you did not receive those two stimulus payments, you can indicate that on your tax return, and you can get it as a credit, which means that if you didn't get it and you calculate and there's a tax liability, the liability will be reduced by the amount of the credit. And if you don't know anything, you should get cash. You should get a check in the mail, or money will be credited to your bank account. Now, the IRS I'm going to be completely honest with you guys, the IRS is in a bit of a mess right now because of COVID-19, and it has led to a fantastic delay. It is, so many of my clients are complaining. So the message I want you to take away is work with your tax team and make sure to try to e-file your returns. Paper returns have been and are being delayed. So I know under certain circumstances you cannot e-file, but work with your tax teams as closely as possible to make sure that you do e-file those returns. Now you can go, the IRS has a portal, and they have like FAQs that, you can go in and you can change your address. So don't be afraid to visit the IRS website. Chances are the questions that you have can be answered by going directly to the IRS website. So please. Okay. In terms of filing requirements, some people think, well, there's a common misconception, right? That, well, I earn less than the foreign earned income exclusion of 100 grand. Therefore, I don't need to pay taxes. Wrong. It may mean that taxes may not be due, so there may not be a liability. But remember what I said? The IRS, the federal government, is all about information. So even though you think you may not owe any money, you still need to submit a tax return. And the threshold for filing a tax return is really low. So this is from the instructions for the Form 1040. And you can see that if you're filing marriage separately, the threshold is actually $5. So if you made more than $5, you have to file a tax return. So it's really low. Please don't assume that you don't need to file. Speak with someone, get advice. And there's a phase out. Most of our clients tend to be higher income earners. And this is a question that we commonly get, like, where's my money? And then I have to explain, well, it's the price of your success. You've done really well. So therefore, there's been a phase out and you're not going to get the stimulus payment because you simply earn too much. So that could be your situation as well. They do phase out. So if you did not get it, it's not because the IRS forgot. It may be because you just earned more than whatever the threshold may be. And the Biden tax plan, it is huge. It is huge. That could be a whole 3-hour presentation on its own. Obviously, we don't have that time. So what I did is kind of like created a snapshot of what are the key takeaways. The key takeaway, I think, is if you earn more than 400K per year, and then you can expect an increase in your liability, because that seems to be the magic number with, at least on the personal tax side, 400 grand. Above that, your tax is going to jump. And depending on your situation, you can be pushed into a 50% tax bracket with some of these extra taxes. On the corporate side, thanks to President Trump, the corporate rate did come down to 21. If President Biden gets it through Congress, it will go up to 28%. So the corporate side is going to increase as well. As well as for those who may run their own companies, because we work with a lot of entrepreneurs, a lot of business owners, people who run their businesses overseas, and they may have been subject to the GILTI tax. If you were falling into that category, the GILTI is expected to increase as well. So again, there's a lot in that magic box in terms of President Biden's tax plan. Nothing is done yet. It still has to get through Congress. There will always be negotiations. There'll always be give and take. But in terms of what he campaigned on, if he were to get everything he wanted, which is unlikely, but if he were, then this is what we're going to expect. So if it is that you fall into one of 3 categories, you're going to make more than 400K a year, you're running a business outside of the US, or you may be affected by the reduction in the threshold for estate tax, then it's something to pick up with your tax team. You may need to do some planning in anticipation of that development. So, and that's it from my side. Again, keep your questions, type them in the box below, and I'll hand over to Ariel.
So thank you, Darren, again, for all the information and insights. I'm Ariel Katz from Arms Katz & Co. A bit about our office, a bit about myself. Our office was established in 1987. We have offices in both Jerusalem and Tel Aviv. We are ranked by Dansmea among the biggest firms in Israel. We're not small, but we're not too big. This means that all our clients know me or other partners very, very good. About me, I'm an accountant and tax lawyer. I'm teaching in the Hebrew University and for sometimes also in the IDC. I have gold medal from the Institute of Certified Public Accountants in Israel. and I appear in the press regularly. So this is just an intro to know about me and our office, Amos Katz & Co. So I want to speak a bit more about the connection between Israel and the US, and to start by talking about the benefits for first-time Israeli tax residents and returning residents. First-time Israeli tax resident and people who were outside of Israel for at least 10 years are entitled to 10 years of exemption, both from tax and reporting, on their non-Israeli sourced income. And this is, of course, a very good tax benefit, tax haven actually, but it's important to understand some issues about it. First of all, the issue of salary. If a first-time Israeli resident have salary from outside of Israel, for example, a US company is paying his salary while he's sitting in Israel, this salary is regarded as an Israeli sourced income, and he will need to pay taxes in Israel on that income. So also with respect to business income. So it's also always smart to consult and think about how to receive this money without the need to report and to pay taxes, and at least how to pay lower taxes on this income. There is also a possibility for adaptation or accommodation year. This means that at the first year, you can decide not to be regarded at the first year as an Israeli tax resident. So you can decide whether you want to stay in Israel or not, and then not to start the 10 years clock. And another thing to talk about is regarding the end of period tax planning. Just a second. Okay, the end of period tax planning, people that are in Israel for 8 years, 7 years, 9 years, and their 10 years of exemptions is about to over. It will be very smart to consult now and think about tax planning and how to receive the money without paying unnecessary tax. For example, if you have a non-Israeli company, if you will take the dividends out from this company to yourself before the end of the 10 years, you will pay in Israel nothing. But if you will receive this dividend 1 month after these 10 years, you will pay full tax on this dividend. So this is just a small example on what is very important to think about the planning of the end of this period. Now I want to use the time left to discuss again some US and Israeli taxation issues. I will give like 2-3 minutes for these issues, so we have time at the end for questions and answers. But if you want to have questions about it, please feel free to write it in the chat and we will reply after it. So the first issue is the tax credit. In Israel, you're getting a tax credit for your US taxes paid, but only for federal or state tax. Federal and state tax, you will receive the tax credit. You're not receiving tax credit, not for city tax and not for national security paid in the US. This brings us to the double taxation problem. We don't have such problem with income tax double taxation, but we have in the connection between Bituach Leumi and national security. Bituach Leumi is the Israeli national security. And people that are self-employed who pays Bituach Leumi in Israel, if they are a US tax person, many times they need to pay also national security in the US. And this is actually a double taxation. We have some solutions to this problem. One solution is to establish a company. It's not always smart to establish a company because you have some cost and expenses to have this company, but this is one solution, but it's something to take in mind. Another issue for US-Israeli taxation is how Israel and the US treat options for employees. People from startups and high-tech industry who move, make a relocation and work some years in the US or some years in Israel. there is some kind of a mismatch between Israel and the US, in the sense that in the US, at least right now, you pay on these options with respect to your time you worked and lived in the country. But in Israel, the new approach of the ITA, the Israeli tax authority, is that you pay on a cash basis. This means that if you work 3 years in the US and the employee receives option and he get it the day he landed in Israel, both US and Israel will want to collect money from these options. And this is something to think about and to find a solution to. Another thing to discuss is the Israeli tax residency. Darren said before that for US tax purposes, you are a US person for all of your life. If you're a US person, it doesn't matter if you live in the US or not. In Israel, it's not the same way. It's not the same thing. In Israel, if you live enough time outside of Israel, you won't be regarded as an Israeli tax resident. And usually we talk about the time limit, it is between 3 to 4 years. If you're outside of Israel below 3 years, 99% of the time, you will be regarded as an Israeli tax resident for all of the period. I mean, if you lived in Israel for 2.5 years, for 2 years and come back, most of the time, the Israeli tax authority will look at you as an Israeli tax resident for all the period. But if you stay more than 4 years, let's say 4.5, 5 years, it's pretty clear that you're not an Israeli tax resident most of the times. However, the timing between 3 to 4 years is the most problematic, and it's not clear and depends on different situations. I want to now mention in a few minutes issues regarding investing in foreign companies from both sides, both US persons investing in Israeli companies and Israeli person investing in US companies. For an Israeli investment in US companies, for example, LLC for buying a property in the US, Israeli tax residents that have investments in US private, not private companies, must file an Israeli tax return. In the other way around, a US person that have shares in Israeli company is not immediately requested to file tax return in Israel, but in some cases he needs to do so. Most of the time, we can leave him out of the Israeli tax system if the Israeli company is withholding taxes from its dividends paid to him. With respect to inheritance tax, estate tax, I assume most of you already know, but in the US there is an estate tax, and if you are a not US person, the threshold of exemption is quite low, around $60,000. So this means that if an Israeli person dies while he have US assets and their value is higher than $60,000, something like that, he will need to pay estate tax in US. And of course, there are some solutions for this to make your investment to a company, to a trust, and also the solution of using a life insurance in order to receive the money that will be sufficient to pay this estate tax. Another thing to discuss regarding investing in foreign companies or foreign activities is the management and control issue. A non-Israeli company that is managed and controlled from Israel is regarded as an Israeli company. This means that this company will have to pay company's tax in Israel, although it was established outside of Israel, for example, in the US. And then for an Israeli person who holds a non-Israeli company, always have to think about from where is the place of the management and control. And if it's managed and controlled from Israel, it can be a tax accident, and it's something to discuss with your consultants. two last topics before we go into your questions is Israeli people investing in US LLC. There's a problem in the investment in US LLCs because in the US, most of the LLCs are transparent. This means that the income moves through the shareholder and it's paid by the shareholders, not by the company. In Israel, not every company can be transparent, and the ITA came up with a solution which is only a partial solution, and I will explain. The solution of the ITA, the Israeli tax authority, is that if an Israeli person holds a US LLC, then he can elect that also in Israel, this company will be regarded as transparent for tax purposes. This means that if the person pays the taxes in the US directly, also in Israel, he will get the credit directly, because otherwise he will have to pay in the US as a person and in Israel as the company. So we have a solution, and the solution is good if you hold one LLC, but this solution is not so good if you hold more than one LLC, and I will explain. Let's imagine a person that holds two LLC at the same time. One of them made a profit of $1 million, and one of them have a loss of $1 million. In the US, both the income and the loss will go to the person, and he can offset them, and he's not supposed to pay any tax in the US. However, in Israel, the approach of the ITA is that although the income or the loss come to the person, he cannot offset the loss of one LLC with the income of another LLC. This will result in this person that made $1 million in one LLC and lost $1 million in the other LLC to pay taxes in Israel at that year, right? Even if the Israeli tax rate is the same as the LLC, and then we understand that usually he should not pay in the US. Usually he should not pay taxes in Israel at all because he should receive the full credit on his US tax paid in the US. In such circumstances where you have one LLC that is making money, another LLC that is losing money, he'll end up paying both in Israel and both in the US. This is something still not solved in the Israeli system. We also deal with it with our clients. I assume that in a few years we'll get a court ruling about this issue, because I assume you understand it is not the way this meant to be. Then last thing I want to discuss is US taxation of exempt Israeli income. In Israel, there are many types of income that are exempt. For example, a person who holds one apartment and sell it. For example, if you have a Keren Ishtalmut and you have income in this Keren Ishtalmut or a pension fund with an income, or if you have income for rent below 5,000 shekels, when you have a lot of exempt income in Israel. And the problem here is that not all of this income is exempt in the US. And in some circumstances, if you're a US person, you may be exempt in Israel, but then you will pay the taxes in the US. And this is also something to think about and to discuss while you're making your tax planning. So this is it, but now we'll take the time. We have around 25 minutes to answer your questions and to hear your thoughts. And again, thank you everybody for joining this webinar today.
All right, so Q&A. We have quite a number of questions, and I actually expected more questions. So I guess as we speak to these, more questions will come from it. The first one was, at some point, please relate to capital gains. Both Israel and America speak to the US side. So capital gains, you have short-term capital gains and you have long-term capital gains. I'm not sure which one the questioner had in mind, but short-term capital gains. So this is when you have a sale on an asset that you've held for less than a year. It'll be taxed at ordinary tax rates, which could be as high as 37%, depending on your situation, right? If it is you had a long-term capital gain, you've sold an asset that you've held for more than a year, it depends on the quantum, but it's either 15 or 20%. So let's say 20%. So it's quite a saving on the long-term versus short-term. Ariel?
Yeah, I want also to discuss if in Israel it is the first time Israeli tax resident or a returning resident to Israel have US capital gains, it's also exempt in the 10 years period. After the 10 years period is also partly exempt. For example, if I hold the asset for 20 years and 10 of the years I'm in the exemption period, I will be exempt for 10 years. In addition, foreign investments, meaning US persons which are not Israeli tax residents who make investments in Israel, are most of the time exempt for their Israeli capital gains. You have some conditions for that, but most of the time they will be exempt, even if it's a traded company or a private company. Private companies after 2009, and most of the traded companies will be exempt.
Okay. Next question, and this one is a direct message, so I don't think you could have seen this one, Ariel. Could you give some examples of how a non-resident may still be considered as domiciled in a certain state? Obviously important with respect to high tax states like California and New York. So I'm assuming that the scenario is that it's a US person, so green card, passport, and they're now living in Israel, and you're wondering, how can I still be stuck to a state? We see it most often with a state like Virginia, where so like New York and California will say, well, if you don't have any real estate empty in California waiting for you to occupy, and you are not spending any time in California, and you are a bona fide resident of Israel, then they will probably be comfortable with saying, well, you're not California resident. Similar to New York, if it is you don't have like a co-op, or you have your condo, you have your home, you have a home that's available, it's just empty, it's not being rented out, that's a key thing, then New York could probably be satisfied. But there are states like Virginia that will say, well, your last state of residence before you left the US was Virginia, and you may still maintain a Virginia driver's license. Maybe you're still registered to vote in Virginia. Virginia tends to be pretty aggressive. They may say, well, we know you're a bona fide resident of Israel, but we still consider you a resident of Virginia as well. So what we do in terms of our consulting is we'll coach our clients. You need to sever tax residence, even if it's New York or California. Pick one of the 8 states without an income tax. So, you know, your Florida, Nevada, Texas, populous states, and make sure you're registered to vote in one of those states, get a driver's license in one of those states, hold mail in one of those states. We can coach you through that, so that if there's ever a dispute, you can definitively demonstrate that you are not still domiciled in Virginia or New York or whatever. You are Florida, you are Texas, as the case may be. So I hope that helps. But again, 50 different states, 50 different rules. Next question. I'm a dual citizen, Israel and USA. I work in Israel, but my employer is in the US, and I get paid in US dollars. Each month, my paycheck is deposited into my US bank. Do I still need to file taxes in Israel first or the US first? From a US point of view, you're definitely going to file and pay taxes in the US. Ariel?
Yeah, in Israel, the test is not regarding if you're a citizen, but whether if you're a tax resident. You can be an Israeli citizen for many, many years, but will not be a tax resident. For example, if you're outside of Israel for at least 4 years, you're probably still a citizen, but not a tax resident. But if you're a tax resident, it depends on your income. If you're only an employee, you don't need to file taxes usually. If you have other types of income, usually you need, but not all Israelis file taxes. It's not the same in the US.
Okay, great. Moving on, someone is asking where would they be able to find the recording later on. I'll have a copy on our website, which is htj.tax. We'll also have it on our YouTube channel. And Ariel?
We'll probably share it by emails and to our clients.
Okay, great. Next question. Hi, if my husband is an Israeli citizen and is the primary provider, do I have an obligation to report his income? Now, from a US point of view, if you're not working and your husband who is not US exposed is working, then you don't have an obligation to report his income. But if it is that you guys have a joint account or he's transferring money to you, then that may be reportable. Again, it may not be taxable, but I would say it may definitely be reportable. Ariel?
Well, my answer is quite the same as the last answer. It depends if you're an Israeli tax resident and what are the types of income that you have. And if you are an Israeli tax resident and you have the type of income that make you file a tax return, then you need.
Okay. Next question is for you, Ariel. It says, I'm just going to read it out because on the recording, they won't be able to see the question. So I'm just going to read it out. If I made Aliyah and left, recently returned after 6 years, do you get the 10-year tax period, Ariel?
Well, in Israel, we have what we call a returning resident and a veteran returning resident. If you're returning while you were outside of Israel for at least 10 years, you are a returning resident. And if you were at least, 6 years, you are a returning resident, and 10 years, you are a veteran returning resident. If you live outside of Israel for 6 years, again, you are returning, and you're entitled for 5 years, not 10, 5 years of tax benefit. But these benefits are not as huge as the benefits for the 10 years. Not only the period of time, but you have minor benefits in these 5 years. If you settle outside of Israel for 10 years, you will be entitled for the whole 10 years of exemption. And there is no problem to be in Israel to receive it once, go outside and come back and receive it twice. There's no problem with that at all.
Okay, that's great. Next question, again about the recording. We responded to that already. We'll have it on our website, htj.tax, and Ariel will distribute it to his clients. Next question. Are there any reporting requirements in the US for real assets held outside the US, such as real estate and precious metals? So I'll answer those separately. For real estate, if it is an income producing asset, yes, you declare it and you pay taxes on whatever the income may be. If it is not an income producing asset and you hold it in your own name, then no reporting. If it is not an income producing real estate asset, but you hold it through a structure, then yes, it may be reportable. Again, no taxes because it's not income producing, but just the existence of it and you hold it through a structure, yes. Precious metals, if it is that you hold precious metals directly, so you have access to a vault, and we have lots of clients with vaults in Switzerland, in Hong Kong, and Singapore. If you hold it directly in the vault, then no. If it is that you hold it through some sort of structure, or it's paper, or it's through a bank, so therefore it's an account number attached to it, then yes. It, again, is not taxable unless there's a sale, but it's reportable as an asset that you hold if you hold it in one of the ways I mentioned. Moving on. I didn't really understand the investment info. If I have an investment account in the US, in which country do I pay taxes on it? Do I need to start filing in Israel too? From a US perspective, if you're based in Israel and you have an investment account in the US gets the first bite of that cherry because it's income that's derived for the US. And Israel,
yes,
Ariel,
Israel agrees that the US have the first bite, but you will have to file taxes in Israel. And if the Israeli tax rate will be higher, to pay the difference in Israel.
Okay, great. So again, just to repeat, you're not going to be taxed twice on the same dollar. You just pay the difference because of the tax credits that Ariel mentioned earlier. Next question. This was a direct one to me, so I'll just read it out. If I'm a US realtor and will complete transactions in the US, does Israel consider scheduling and research phone calls work in Israel? So this is one for you, Ariel, because I guess this falls into management and control. This person is a US realtor and they're doing research and they're doing phone calls from within Israel. Over to you.
Can you please repeat this question because I'm not sure I understood?
Sure. He or she is a US real estate agent,
Yes.
but they are presumably based in Israel. And while they're in Israel, they're running the business in the US. So they're doing scheduling, they're doing research, and they're doing phone calls. Is that
I see.
considered to be work in Israel?
Well, first of all, it depends on how do you get this income. If you're getting it directly as a person, of course, you have to open in Israel עוסק מורשה, which is a dealer in Israel. You have to be self-employed for VAT and income tax, and you have to file taxes in Israel. And Israel will tell you that Israel have the first bite on this income because you make it from Israel. If you make this income via a US company, it's a bit more complex. And as Darren said, it depends whether the management and control is from Israel or not. Do you have employees in the US? Do you have someone in high rank in the US to manage the business? Then maybe it's not an Israeli management control company. But if you're the manager who wants like 100% of the company is doing all the work from Israel, Israel will tell you that this is probably a managing control company from Israel. So even if it's a company, you have to pay taxes on this company's income. And again, for what I said at the beginning, if you have this income directly, it's 100% that you have to file taxes in Israel. And also you will not get, in most cases, you will not get credit for taxes paid in the US, since for Israeli tax purposes, it will be regarded as the business is operating from Israel. This is a Israeli source income.
Okay. We have 10 minutes left, so we'll try our best to get through as many questions as possible. A lot is coming in. What are my US and Israeli liabilities for certain pension and mutual funds? It depends. We'll need to look at them, myself, I'll sit with Ariel, we need to look at them because under the US tax code, there's a certain category of investment account, which is called a passive foreign investment company, a PFIC. And with those, they're treated very aggressively by the IRS, which means that even though there's no distribution, there's no liquidity event, you're not taking any money out, there was no distribution to you. Once there's a gain on the funds inside of that account, it may still be subject to US taxes. So there's a tax on phantom income. Just by holding whatever the investments in the pension or mutual fund, it may be taxable on your US returns. So that's from the US side. We'll need to take a look at it. Ariel, on the Israeli side?
In Israel, usually, if it's Israeli pension fund, Israeli קרן השתלמות, Israeli קופות גמל, it's usually exempt most of the time.
Okay, that's great. Okay. Next question. I do have Karen Histelmuet here in Israel that has had quite a high gain. When do I pay US tax on this? From a US perspective, if it does fall under the exemption, then there will only be tax upon distribution. Otherwise, it'll be subject to the PFIC treatment that I mentioned earlier. Ariel?
You said correctly, in Israel it should be exempt.
Okay, great. Moving on. I have stocks in the US. When I sell them, I pay long-term capital gains in the US or Israel after the 10-year exemption. Obviously, there's stocks in the US as US citus assets with US derived income. So the US will get first bite of that cherry. Ariel?
Yes, and as I mentioned previously, you will get a partial exemption even after the 10 years period. If you bought the asset, the share, or whatever it is before the end of the 10 years period, in Israel, you'll get a partial exemption even if the 10 years were ended.
Okay, that's great. Next question. Can you explain about the reporting regarding Bitcoin? And that's new on the US tax return. It's like one of the first questions on the 1040 crypto. From a US perspective, generally speaking, is considered an asset, not a currency. It's considered an asset. So if there's a gain on it, you buy and you sell at a higher price. If there's a gain, it's reportable. So it's either long-term or short-term capital gain, or long or short-term capital loss. And the key thing that we tell our clients who are involved in crypto, you must keep records. You must keep records. That's the only way we're able to track the gains or losses from a US perspective. Ariel?
Yeah, in Israel, it's quite the same. It's also regarding an asset. In most of the time, we treat it as an asset, so meaning it's a capital gain.
Okay. Next question. What about Social Security? Bichwa Kliumi, do you know of any relief for US citizens living in Israel who are either freelancers or work in the US? Social Security. Ariel?
Well, as I said before, this is quite a problem, the issue of social security and bituach leumi. Usually to go to Soviet is to operate via an Israeli company, because otherwise you will pay both national social security and bituach leumi. And as far as I know, there's not much of a relief.
Understood. Next question. This year, when do you have to file taxes in the US and Israel? Does Israel have extensions like in the US? I'll speak to the US part. There are two deadlines. If taxes are due, they're due by April 15th. By virtue of being outside of the US, you have an automatic extension until June 15th to file the return, which I know seems kind of weird. So the tax liability is due before the actual return. But that's the way the IRS is. If you can't make June, then you can apply and get an extension to mid-October, and failing that to mid-December, but that's, we try to get it done by October. So those are the deadlines from a US perspective. Ariel?
In Israel, if you file a loan without any help, it's usually between May and June. If you use an accountant in Israel, usually you can receive extension by the end of the next year.
Okay. Someone is asking about Ariel, your fees. So I guess they answer you need to contact Ariel or his team directly, and you'll be able to work out what their fee schedule is. Next one, if I have capital gain in the US and I reinvest it, is it considered as an expense, or can I avoid taxation in both countries from a US point of view? The answer is it depends. There's something called a 1031 like-kind exchange, which has been pretty generous in the past, but has been tightened, and it applies primarily to US sites as real estate. So if you have a capital gain, but within a certain number of days you buy another property, you can defer having to pay that capital gain. But otherwise, once there's a liquidity event and you make money, you need to pay taxes, even though you're going to reinvest it into something else. Ariel?
Well, in Israel, usually when people change assets, we usually saw it when people buying and selling real estate actually in the US and getting exemption in the US. In Israel, usually there is no exemption. You can go to a ruling, but usually there is no exemption, and it's also something quite problematic. We have here in Israel what we're calling shichluf nechassim, and sometimes you can, if you meet the condition, receive also the exemption in Israel if you meet the Israeli condition for shichluf nechassim. But this is something that you need to consult before making the action, because otherwise you may end up with an exemption in the US and a tax payment in Israel. And then you will pay the tax again while we say sell in the US. So we pay the tax twice. So this is a problematic issue, and always to consult before making this action.
Okay, great. Next question, how can I reduce in a tax-wise manner, or I guess tax-efficient manner, my capital gains? I guess, it really depends on the asset class. It depends on your situation. It depends on where the asset is situated, what your situation is. So I think you'd need to consult a tax team to get a specific answer to that question. We have 10 more questions. We can't get to all, so we can see what we can do. Oh no, scroll. That was a glitch from Zoom. One more question. Is there any benefit as an Israel tax resident to investing in a Roth IRA, etc.? Will the tax exemption in the US be canceled out? by having to pay taxes in Israel? That's one for you, Ariel.
If you are in the exemption period, then it will be exempt in Israel. Otherwise, you will not benefit from these US benefits, and yes, you will end up with paying taxes in Israel. So it's the same problem I introduced before with Israel exempt income. Now we see the other side of it when you have a US exempt income, but you need to pay Israeli taxes on it.
Okay, so it seems as if we've come to the end of our list. Oh, there's one more question. If you're not sure you'll be in Israel forever, would the Roth IRA potentially be worth it? Ariel?
Well, I'm not actually sure what is a Roth IRA. This is like a IRA fund, you mean? Because in Israel, you usually pay the tax when you sell the assets, and if you invest via a fund, it depends whether it's a transparent fund and then you pay on each sale, or is it not a transparent fund and then you pay only when you sell the fund or liquidate the fund. So it depends.
So in the US, I guess there are different ways of looking at retirement funds, but just being very, very general, there are those that you fund. There's a retirement fund that you can fund with pre-tax income, like a 401k. So you get a tax exemption. So you reduce your taxable income, you put it in the fund, but once you retire and you get a distribution from it, it'll be subject to tax at whatever your marginal tax rate is at your point in time of retirement. The other one would be like your Roth, which you fund with after tax income. So you get no real tax deduction. It's already taxed money that you're going to throw in. But the good thing is that when you're pulling it out, it should be, all things being equal, tax free. She's written that it's like a Korean HTJ.
So in Israel, so if it's like Kenish Talmud, and in Israel, usually these funds, if they are not transparent for Israeli tax purposes, and from what you described, it seems like a not transparent, then you will only need to pay taxes once it's sold. And if you leave Israel, usually you will not have to pay taxes, although you have what we call in Israel an exit tax. And in certain circumstances, if you leave Israel with some assets, you will need to pay the tax or to postpone the tax to the date when you will sell it. So you may have some taxes exposure on this exit tax, but it's not a very high exposure.
Okay. And with 1 minute to go, there's one direct question to me, which I will read aloud. What other document we need to provide other than a W-9 or 1099 when we file our taxes in Israel for the first 10 years as a returning citizen, still working for a US employer?
For the first 10 years, you don't have to file anything regarding your non-Israeli source income. But if, again, it's a salary that you made from Israel, which is regarded as an Israeli income, you usually have to bring your W-2 and your US tax return in order for us, for Israeli advisor, to understand the amount of the income and the amount of tax paid in the US. And by the way, in this point, if you live some of the time in Israel and you spend some of the time in the US, for example, if you 2 weeks in Israel, 1 week in the US, then you can get a partial exemption on this income.
Okay, that's great. I'm afraid we've come to the end of our time period. Thank you very much. And again, I'm htj.tax. You can reach out to us via that website. And Ariel?
Yeah, thank you very much, Dan. Thank you everybody for joining us today. Ariel Katz for Amos Katz & Co. And we will share this presentation webinar quite soon.
Thank you very much. Bye-bye.
Thank you.
Here are 4 ways we can help you. Number 1. Sign up for free webinars on US expat taxes and international entrepreneur taxes at www.htj.tax. Number 2. Stream premium educational videos at www.htj.tax. Number 3. Contact us for tax optimization consult over Zoom. Number 4. High net worth. We can quote for doing your U.S. international taxes returns. Our books and upcoming event are available at htj.tax. Please subscribe, like, share, and comment below. Email us at help@htj.tax to engage us, to advise on international tax or business matters.